All right, let's dive right into this. Welcome to today's explainer. We're going to challenge a baseline assumption I bet you make almost every single day. But hey, real quick before we jump in, if you enjoy these clear, no-nonsense breakdowns of complex topics, please make sure to subscribe to the channel so you never miss an explainer. So, today we're looking at a single word that just gets thrown around constantly, on financial news, at dinner parties, all over your social media feeds. That word? Investment. We're going to unpack the absolute core difference between true investment and mere speculation. Because the truth is, people casually use the exact same word to describe two completely different financial behaviors. And honestly, really getting this difference, it could completely shift how you view your entire financial world.
It begs a pretty fascinating question, right? Is every single asset we buy actually an investment? Think about it. We put our hard-earned money into things all the time. Stocks, real estate, digital coins, plots of land. We hit that buy button on our phone and immediately tell ourselves, awesome, I just made an investment. But our source material today challenges that knee-jerk reaction. It points out that just because you buy something hoping to make a profit, well, that doesn't automatically magically make it an investment. We really need to draw a hard line in the sand here between two very distinct behaviors.
Section 1. Two different types of investment. Section 2. The power of productive assets.
Okay, so to really understand the difference between these two asset categories, we've got to look under the hood at the underlying mechanics of the assets themselves. If we want to define what a true investment actually is, we have to look at the absolute gold standard of genuine value creation, which is the productive asset. Now, notice the word estimated here. When you buy a productive asset, you don't have to just guess its worth based on abstract market vibes or sentiment. You can actually estimate its value by looking directly at the tangible output it literally produces over time. A real investment pays you because the asset itself fundamentally produces something of intrinsic value. It's actively working, it's actively generating, it's actively creating a tangible result. It isn't just sitting there passively, crossing its fingers and waiting for the market winds to change.
Let's make this abstract idea incredibly concrete. Just picture these classic engines of production. If you buy a farm, that farm literally grows crops, right? The dirt, the water, the seeds, they literally combine to produce a physical commodity that holds real value. If you buy an apartment building, well, that rental property generates income through the rent collected from tenants who actually need a place to live. And if you buy a share of a successful business, that business is out there in the real world selling products or services and earning actual profits. The farm, the apartment, the business, they all share this exact same DNA. They are internal engines of production.
Which brings us to this really fascinating thought experiment from our source. Imagine the stock market is just closed. Imagine the ticker screens go completely dark today, or maybe they stay closed for an entire week. The source argues that for productive assets, it doesn't really matter at all. And why is that? Because that farm, it's still growing crops. The apartment building is still housing tenants who owe rent at the end of the month. The business is still selling products to its customers. True value creation absolutely does not rely on daily price tickers flashing red or green on a screen. You could own these assets entirely privately, with literally no public market telling you what they're worth every second of the day, and you could still fully expect them to create value over time simply because of what they produce.
Section 3. Speculation and cryptocurrencies.
All right, now we have to compare those productive assets with the challenger in today's financial landscape, speculative assets. Our source points to Bitcoin and various other cryptocurrencies as a prime example to draw this contrast, and it does so neutrally and purely mechanically. Notice what is entirely absent here: intrinsic production. They don't produce cash flow, they don't grow crops, they don't collect rent, they don't generate business earnings. We're looking at a total absence of those productive engines we just saw on the farm or the apartment building. The asset itself is mechanically inactive when it comes to generating new internal cash flow.
So you're probably wondering, if the asset doesn't fundamentally produce anything, where on earth does the financial return actually come from? Well, our source lays it out pretty plainly. Their value depends largely on what someone else is willing to pay for them in the future. In these cases, your expectation as a buyer isn't that the asset will create its own internal income. Your expectation, really your hope, is solely that the next buyer is going to step up and purchase it from you at a higher price later on. You're relying entirely on the external market, not on internal production.
Section 4. What is the core difference? So if you want a really practical mental filter to cleanly distinguish between these two concepts in your own financial life, well, it's captured perfectly right here. This is the absolutely crucial takeaway you need to remember from our source material. On one side, owning a productive asset means owning something that produces value itself. It pays you because it actually works. But on the other side, owning a speculative asset means holding something whose return relies primarily on finding someone else willing to pay more for it later. One is an internal engine of creation. The other is a reliance on future market demand. True investments pay because they produce. Speculation pays only if someone else is willing to pay more down the road.
And that leaves us with a final, pretty provocative thought. As you look at the assets you hold right now, or maybe the ones you're planning to buy soon, ask yourself, are you betting on future value driven by the next buyer, or are you investing in present, tangible production? What truly defines your financial portfolio? Take some time to reflect on that. Thank you so much for joining me for this explainer. And hey, remember to subscribe to the channel if you want to keep unpacking these fascinating concepts together. Catch you next time.